In early 2021, two friends, Maya and Ben, decided to start investing. They both had $10,000 saved up from working hard and being careful with their money. They opened accounts at the same popular brokerage on the very same day. Fast forward 5 years to today, May 2026, and they meet for coffee. Ben sighs, stirring his drink, and admits he's down to about $7,000. He complains that the market is just a casino, rigged against the little guy. Maya, on the other hand, quietly mentions her account is now worth over $16,000. Ben is stunned. They started at the same time, with the same money, in the same market. What on earth happened? This isn't just a story. It's the reality for millions of people. The stock market, over the long run, is one of the most reliable wealth-building engines ever created. The S&P 500, which is just a basket of the 500 biggest US companies, has returned an average of about 10% per year for nearly a century. Yet, study after study shows that the average investor doesn't get anywhere close to that return. They lose money, or they barely break even after inflation. There's a huge, gaping canyon between how the market performs and how the average person's account performs. And that gap is where financial dreams go to die. The reason for this gap isn't that the system is rigged, not entirely anyway. It's not because you need secret knowledge or a fancy finance degree. The reason is a series of predictable, psychological traps and simple mathematical mistakes that almost everyone makes. Ben fell into every single one of them, like someone walking through a field of rakes in the dark. Maya, on the other hand, understood that winning at investing isn't about being brilliant or finding the next big thing. It's about consistently not being stupid. And by the end of this video, you'll understand the exact traps Ben fell into and the simple, almost boring system Maya used to succeed. Let's start with the biggest reason people lose money, the one that derails more investors than all the others combined. It has nothing to do with numbers and everything to do with feelings. This is the emotional roller coaster, and it's the most expensive ride you'll ever take. When Ben first invested his $10,000, the market was hot. He put it all into a popular tech stock everyone on the news was talking about. For a few months, it went straight up, and his account hit $12,000. He felt like a genius. He started checking his brokerage app 10 times a day, getting a little dopamine hit every time he saw the green numbers. This feeling is called overconfidence. It's the belief that because things are going well, you're the one responsible, that you have some special skill for picking winners. It's the first and most dangerous peak on the roller coaster. Then, the market hit a rough patch. A bit of bad economic news came out, and his chosen stock dropped 20% in a single week. His $12,000 became $9,600. The genius feeling vanished instantly, replaced by a cold knot of dread in his stomach. This is fear, and it's amplified by a powerful psychological bias called loss aversion. Studies show that the pain of losing a dollar feels twice as powerful as the pleasure of gaining a dollar. Ben wasn't thinking about the company's long-term prospects. He was just thinking about stopping the pain of seeing his balance go down. So he sold everything. He hit the sell button to make the bleeding stop, locking in his $400 loss. He told himself he'd get back in when things calmed down and the market looked safer. Of course, a few weeks later, the market recovered and his old stock shot up to new highs. But Ben was on the sidelines, sitting in cash. He missed the entire rebound because he was waiting for a clear all-safe signal that never comes. This single emotional decision, selling low out of fear, is the #1 destroyer of wealth for individual investors. It is the original sin of investing. This isn't just an anecdote. A report from the research firm Morningstar, covering the decade through 2024, quantified this exact problem. They found that while investment funds returned an average of 8.2% per year, the average investor in those very same funds only earned 7%. That 1.2% gap is the documented cost of bad timing. It's the price people pay for jumping in and out, for selling in a panic and buying back in too late after the recovery has already happened. It's called the behavior gap, and it's a multi-billion-dollar mistake. So what did that 1.2% gap actually cost someone? Let's run the numbers. If you invested $10,000 and earned the full 8.2% for 30 years, you'd end up with about $108,000.
But if you were the average investor who earned only 7% because of bad timing, you'd end up with just $76,000. That gap, that series of small emotional mistakes, cost you $32,000. It's a massive self-inflicted wound. The market didn't take that money from you. Your own behavior did.
Meanwhile, what was Maya doing during all this? She put her $10,000 into a simple, low-cost S&P 500 index fund. When the market dropped, she didn't check her account. In fact, she had deleted the brokerage app from her phone's home screen. She had set up an automatic $200 investment every single month, no matter what. So when the market was down, her automatic purchase just bought her more shares at a discount. She wasn't trying to time the market. She was just spending time in the market. She replaced emotion with automation, which is the closest thing to a superpower an investor can have. After his first mistake, Ben was hesitant. But then he started seeing news about a new meme stock that was supposedly going to the moon. His friends were talking about it in their group chat. Social media was buzzing with rocket emojis and wild price predictions. He felt that familiar itch, the fear of missing out, or FOMO. He saw the stock double in a week, and he couldn't stand the thought of everyone else getting rich without him. So he jumped in with both feet, buying near the very top of the hype cycle. You can probably guess what happened next. The hype faded as quickly as it appeared. The early investors cashed out their massive profits, and the stock crashed, falling over 80% in a matter of days. Ben's investment evaporated. He bought high out of greed and FOMO, which is the exact opposite of selling low out of fear. He was just playing the same emotional game from the other side of the roller coaster. But it's not just our emotions that get us. There's a more active way people try to beat the market, and the stats on its failure are genuinely shocking. This brings us to the second major reason investors lose money. They stop investing and start gambling. They get tired of slow and steady and decide to become a day trader. After his losses, Ben decided his problem was that he wasn't paying close enough attention. He needed to be more active. He set up a desk with multiple monitors, subscribed to a fancy charting service, and started watching the market all day. He was trying to buy a stock in the morning and sell it for a small profit in the afternoon. He was day trading. The appeal is obvious. It feels like you're in control, making quick, smart moves and outwitting the market. The reality, however, is brutal. He wasn't investing in businesses anymore. He was betting on squiggly lines on a screen. The data on this is incredibly clear and consistent across decades and countries. Study after study shows that between 90 to 95% of day traders lose money and quit within a year. A 2025 analysis of brokerage data found that over half of all active day traders incurred a net loss. Think about that. It's a profession where the vast majority of participants fail spectacularly. You have better odds playing roulette in Vegas. The reason is that you're not playing against other amateurs like yourself. You're playing against billion-dollar hedge funds with armies of PhDs and AI-powered supercomputers that can execute trades in microseconds. Here's a fascinating statistic that really explains the trap. A 2023 study looked at thousands of retail traders and found something surprising. It found that 65% of them had a win rate above 50%, meaning more of their individual trades were profitable than not. If you asked them, they'd probably tell you they were doing pretty well. But here's the catch that ruins everything. 82% of those same traders still lost money overall. How is that even possible? It sounds like a riddle. The answer lies in the size of their wins and losses. Their average winning trade was tiny, maybe a 1% gain that they cashed out quickly, afraid to lose it. But their average losing trade was much bigger, like a 3 or 4% loss, because they held on, hoping it would turn around. They'd make 5 small winning trades of $40 each, feeling great about their $200 profit. And then one bad trade would go against them, and they lose $500. Their risk management was completely backward. They were picking up pennies in front of a steamroller. This is exactly what happened to Ben. He'd make $40 on one trade, $50 on another, and feel like he was finally getting the hang of it. He'd text his friends about his wins, but he never talked about the losses. He'd make one mistake, hold on to a losing position for too long, hoping it would come back, and end up losing $500. His small wins were constantly being erased by one big emotionally driven mistake.
He was just churning his account, racking up transaction costs and slowly bleeding money without even realizing the pattern.
So, if riding the emotional roller coaster and gambling on short-term trades are losing strategies, what's left? Unfortunately, even if you avoid those obvious traps, there are still hidden leaks that can sink your financial ship over time. They are quiet, slow, and deadly. I'm talking about fees and taxes. They don't feel as dramatic as a market crash, but they are just as destructive over the long term because they are guaranteed losses. Let's talk about fees first. Many mutual funds, especially those actively managed by someone in a suit, come with an annual management fee, also called an expense ratio. A common fee is around 1%. That sounds tiny, right? It's just 1 penny on the dollar. But it's not. That 1% isn't a one-time fee. It's a 1% fee every single year, charged on your entire balance. Let's go back to Maya's $10,000. Imagine she invested in an actively managed fund with that 1% fee, instead of her low-cost index fund, which has a fee of just 0.04%. Assuming a 7% average annual return, after 30 years, her account in the high-fee fund would be worth about $58,000. Not bad. But in the low-cost fund, it would be worth over $76,000. That tiny 1% fee cost her $18,000. It consumed nearly a quarter of her potential earnings.
Shh, here's the part they don't like to advertise. That fee is charged whether the fund does well or not. If the market is down 10%, you lose 10% and you still pay the 1% fee. It's a guaranteed return for the fund company, but not for you. It's a constant headwind, a perpetual drag on your performance, silently eating away at your potential growth year after year. So in plain English, high fees are a mathematical certainty that turns a winning investment into a mediocre one, and a mediocre one into a loser.
Then there are taxes. This is where Ben's day trading really came back to bite him. Every time he sold a stock for a profit, even a tiny one, he created a taxable event. Because he held these stocks for less than a year, his profits were considered short-term capital gains. In 2026, these are taxed at your ordinary income tax rate. For Ben, that was 24%, plus state taxes. He was giving away a huge chunk of his winnings before he even had a chance to reinvest them. Maya, on the other hand, just held her index fund. She didn't sell anything for 5 years. By holding her investment for more than a year, any future gains she realizes will be considered long-term capital gains. The tax rates on these are much, much lower. 0, 15, or 20%, depending on your income. For Maya, it would be 15%. By simply doing nothing, she allowed her money to grow in a much more tax-efficient way. The difference between a 24% tax and a 15% tax is enormous over a lifetime of investing. It's another self-inflicted leak Ben created through hyperactivity. So we have emotions: gambling, fees, and taxes. These are the big 4 destroyers of wealth. But there's one more subtle trap that even smart, well-intentioned people fall into. It's the belief that more complexity equals better results. At one point, Ben thought his problem was that he wasn't diversified enough. So he started buying lots of different funds. He bought a tech fund, a healthcare fund, an international fund, a small cap fund, and a dividend fund. He felt very sophisticated. His portfolio looked complicated and impressive on paper. But when he actually looked under the hood at the top holdings of each fund, he realized they all owned many of the same large companies: Apple, Microsoft, Amazon, Nvidia. He wasn't actually diversifying. He was just buying the same stocks in 5 different expensive packages. This is called overlap. This is a phenomenon sometimes called diversification. You add more and more investments, thinking you're spreading out your risk, but you're actually just adding complexity and cost without any real benefit. You end up with a portfolio that is confusing to track, expensive to own, and ultimately just mimics the total market anyway. Why pay 5 different managers a 1% fee each to essentially buy you the S&P 500 when you can just buy the entire S&P 500 yourself for next to nothing? It's a trap, sold to make you feel like you're doing something smart when you're just making things worse. Maya's strategy was the opposite of complex. She owned one thing: a total stock market index fund.
That single fund gave her ownership in thousands of companies across every sector of the economy, all in one simple package. It was the ultimate diversification in the simplest possible form. She didn't need to be an expert on healthcare or technology or international markets. She just made a single, broad bet on the entire American economy to continue to grow over time, which is historically a very, very good bet to make.
So let's bring this all together. Why did Ben lose $3,000 while Maya made $6,000? It wasn't because she was smarter or luckier or had some secret information. It's because she understood the game she was playing, and Ben did not. Ben thought investing was about action, finding the hot stock, timing the market, making clever moves, and being active. He was playing a speculator's game, a game that is statistically stacked against him due to emotions, fees, and taxes. He was trying to find the single magic needle in a giant haystack. Maya understood that true investing is about inaction. It's about simply owning the entire haystack and then having the patience to let it sit there and do what haystacks do, which in this metaphor is grow steadily over time. Let's put it on a final scorecard. Ben's strategy was driven by emotion. Maya's was driven by automation. Ben was a hyperactive trader. Maya was a passive owner. Ben paid high fees and high taxes. Maya paid almost nothing in fees and deferred her taxes. Ben chased complexity, thinking it was sophisticated. Maya embraced simplicity, knowing it was effective. Ben lost, Maya won. It's really that straightforward.
She won by systematically avoiding the mistakes that Ben made. She didn't panic sell. She didn't chase hype. She didn't day trade. She kept her costs and taxes incredibly low. And most importantly, she automated her decisions. So her own worst enemy, her emotional human brain, couldn't get in the way. Her strategy was simple, disciplined, and honestly, kind of boring. And in investing, boring is beautiful. Boring is what gets you rich. The stock market is an incredibly powerful tool for building wealth over a lifetime, but it's a terrible, terrible way to try to get rich quick. The people who lose money are the ones who treat it like a casino slot machine, pulling the lever and hoping for a jackpot. The people who make money are the ones who treat it like a garden. They plant good seeds in good soil, water them regularly without fail, and then have the patience to let them grow over decades. So, if you want to avoid being like Ben, the takeaway is simple. Your one action for today isn't to go find the next hot stock. It's to make one decision that removes the need for thousands of future emotional decisions. Go into your brokerage account, find a low-cost, broad market index fund, like one that tracks the S&P 500 or the total stock market, and set up an automatic recurring investment. It can be $50, it can be $500. The amount doesn't matter as much as the automation. Automate your success so you can't sabotage it. If you do that one thing, you have already put yourself ahead of the majority of investors who let their emotions and a desire for excitement get in the way of their own financial future. You'll be on the calm, boring, and profitable path. If this breakdown of investor behavior was helpful, a subscription to the channel is always appreciated. In our next video, we'll talk about the right way to use debt. Thanks for watching.